You ever see a company report great numbers, and then the stock just tanks? It's baffling, right? Well, that's pretty much the story of Toast's latest earnings report. On paper, it looked like a win, but the market's reaction told a completely different story. So let's unpack the why.
All right, let's get right into it. First up, the earnings snapshot. So if you were just scrolling through the headlines, you'd think Toast absolutely crushed it this quarter. And, on the surface, they really did. They delivered results that were better than Wall Street was expecting. I mean, just take a look at this. It was a clean beat on both the top and bottom lines. Their earnings per share came in at 16 cents when analysts were only predicting 12. That's a nice surprise. And revenue? It landed at $1.63 billion, edging out the $1.62 billion estimate. So by any standard measure, this was a solid report, right?
Well, this is where the plot thickens. Despite those good-looking numbers, investors basically looked at them and said, nope, not impressed. The market decided to sell the news.
We're talking a drop of almost 6% in after-hours trading. So what gives? Why the huge disconnect between the results and the reaction? To figure that out, we have to dig a lot deeper than these headline numbers. We need to listen to what management was actually saying.
And on the earnings call, management was painting a very, very confident picture of the future. Let's break down their growth story.
They laid out this four-part game plan. First, keep dominating their core business, which is U.S. restaurants. Second, start pushing hard into new territory. Think retail, big enterprise clients, even international markets. Third, get their current customers hooked on more features, especially their new AI tools. And finally, number 4, do all of this while actually making more money. Expanding those profit margins. It's that classic growth story playbook.
And get this, the CEO, Aman Narang, dropped this super ambitious quote. He's talking about taking their annual recurring revenue, or ARR, from around $2 billion today all the way up to $5, maybe even $10 billion and beyond. I mean, that is the big, bold, long-term vision that they are selling to Wall Street.
And look, it's not just talk. They had the numbers to back it all up. Their recurring revenue is already over $2 billion, and that's up a healthy 26% from last year. They added a record number of new locations, 30,000. Payment volume through their system is surging. Plus, they announced a cool new partnership with Instacart and a massive $500 million share buyback program. So it really feels like the business engine itself is just humming along beautifully.
Okay, so if the quarter was good and the long-term story sounds great, what's the problem? Well, the issue seems to be what's happening in between today and that $10 billion future. And that brings us to the guidance and the headwinds.
All right, so here's their forecast for what's coming next. And honestly, the numbers aren't bad at all. But you've got to remember, for a high-growth stock like Toast, good isn't always good enough. Investors were hungry for more. They wanted to see a crystal-clear, super-fast path to big profits. And this guidance, well, it just felt a little soft. It hinted that getting to those fat profit margins might take a bit longer than everyone was hoping for.
And you got to remember that context is everything here. Investors are not just looking at this one report in a bubble. They're looking at the big picture.
And that is where this chart tells a really powerful story. Over the last year, Toast has been a major laggard compared to the overall market. So if you're an investor who's been holding on to this stock, you're probably feeling pretty frustrated. You came into this earnings report needing a home run, not just a solid single. You needed something to finally change the narrative. And that good but not great guidance, it just wasn't the knockout punch they were so desperate to see.
So let's put all the pieces together. We've got the solid earnings beat, the big growth story, the kind of mad guidance, and a pretty impatient investor base. What does it all mean? Here's our take on the next call.
So looking ahead, what's the call? What are the key things that we should all be watching for?
All right, here's what we're predicting. First, it's going to be all about the margins. Forget just top-line growth for a minute. The big question is, can they prove they can be consistently profitable? Second, that retail expansion story, we need to see the proof. Watch the number of new retail locations they sign up. That is the key metric. Third, don't expect the stock to do a whole lot of anything until they really prove out that profit story. It's likely going to be stuck in a range. And finally, that $500 million buyback, yeah, they'll probably use that to put a floor under the stock price if things start getting shaky.
So when you add it all up, our rating on the stock is market perform. Look, this is a good company. They're executing, and the opportunity in front of them is massive. But right now, it is a show-me story. The market needs to see the path to profitability, not just hear about it. Until then, we think the stock will probably just perform in line with the rest of the market. The conviction just isn't there yet.
And as always, please remember this is not financial advice.